This is On The Charts with Nick Radge, your Australian stock market update, highlighting stocks on the move so that you can invest with confidence and success.
The information in this podcast is general advice only and does not take into account your personal situation. Please consider if it is appropriate to you and consult a licensed professional before making any investment decisions. The information provided is believed to be accurate at the time of recording.
Welcome to the On The Charts podcast, episode 192 for Wednesday, 10th of May 2017. US markets continue to trade in a subdued fashion. The two main indices closed marginally lower last night, but the tech-heavy Nasdaq closed at a record level. Airline stocks rallied after American Airlines reported record traffic numbers. Its shares are up 4.75%, as were Continental's. Delta's strengthened 2.2%, and Marriott Hotels reported strong earnings, pushing its shares over 6% higher on the day. Oil failed to follow through last night, settling 1.2% lower, but is finding a renewed bid in Asian trading today. In other news, founder of large hedge fund DoubleLine, Jeff Gundlach, came out suggesting emergent market equities was a better bet than US equities, and even went on to suggest that the S&P 500 should now head lower. In Australia, it was a bit of a guess after yesterday's rout in banks and confirmation of the levy during the budget last night. Also confirmed by the budget was the strength of infrastructure stocks, with the likes of CIMIC, Boral, Downer and Lendlease all gaining nicely today. The budget outlined a $75 billion infrastructure package to be spent over the coming 10 years, and analysts over at Macquarie suggest this trend will continue, as well as for those companies tendering, such as diversified engineers, suppliers and other infrastructure developers. The local market also got a boost from stronger than expected Chinese inflation data. On the flip side, one of today's biggest losers was CSR, which fell about 12% after the company suggested the home building market may have peaked, and profit and dividends came in also below consensus opinion. Another big loser today was Quintis, the sandalwood grower, after a supply deal had been terminated but was not passed on to management. Its shares tanked more than 40%, down to 63 cents and new multi-year lows. We'll probably hear more about this. It was just a month or so ago, analysts were extremely bullish, valuing the stock at up at $3.20 based on expectation of new deals being brokered. Mind you, at the same time, they also acknowledged concern that one major client had not yet placed any orders for 2017. And as for the prior trend of Quintis, well, it was pretty clearly down. Before today's carnage, the stock was already 42% lower from its 2016 highs. And you know my thoughts on that. Those that pick bottoms get dirty fingers. At the close, the ASX was 0.6% higher, quite a good performance. Consumer discretionary and materials led the way, healthcare not far behind. Now, the small ordinaries has been in a state of slumber for the last 6 months, but it's now showing signs of awakening. The pattern progression since late 2015 continues to be very bullish in our view, even though a broad consolidation has been pretty frustrating for investors over the last 6 months. That's simply part of the ebb and flow of the market, and those that attempt to time via sector rotation be damned. Since October last year, the index has stalled in an ascending triangle pattern, which in fact is actually quite the textbook formation at this stage of the trend, and is why we retain an upbeat view of this part of the market. I've mentioned in previous podcasts that this is the area where I focus my retirement funds, and as it offers the greatest risk-adjusted returns. The small cap growth portfolio is the ideal tool to get you involved when the market is rising, and more importantly, get you out if and when it starts to reverse. The small cap growth portfolio has slowly been adding positions over the last few weeks, and personally I'm now about 55% invested, up from about 25% just a few weeks ago, and I'll continue to get fully invested should the upside break occur. If you're interested in seeing my own positions or following the small cap growth portfolio, just take advantage of our 2-week trial today. Origin Energy also looks pretty interesting on the charts. The company is involved in the exploration and production of oil and gas, electricity generation, and both wholesale and retail sale of electricity and gas. The company just announced the sale of its Stockyard Hill wind farm to the Chinese at a better than expected price, as well as locking in a 12-year agreement on the power purchase price, which was below the $65 per megawatt rate. Analysts also suggest the benefits of the wholesale electricity prices haven't been fully priced in as yet, and its utilities business continues to perform very, very well. Price action for Origin is decidedly bullish, with pattern progression showing extensive upside potential in our view. The stock added 2.6% yesterday to break out of a recent phase of distribution and could be the start of the next leg higher. The initial conservative target is around $8.93, but should the trend continue in a textbook manner, we'd expect prices well through $10 in the coming year. Whilst the upside is enticing, more so is the low-risk opportunity currently on offer. A reversal from here and back below $7 said red flag and would be an opportune time to take a defensive action and reassess. We have no issues of being wrong, so long as the losses remain very, very small and we allow that upside potential to unfold. My name is Nick Radge. If you're looking for some guidance on how to manage your portfolios in a proven and systematic way, I invite you to investigate our growth portfolio or our US momentum strategies, both of which I personally trade and really enjoy using. I'll see you on the charts tomorrow.
On the Charts with Nick Radge, brought to you by The Chartist. Join Nick and the team at Noosapalooza Trading and Investment Conference, 20th and 21st of July in beautiful Noosa, Queensland. Visit thechartist.com.au and click on Noosapalooza in the menu for details.